Move forward, quick reminder for everyone, this is for education purpose only, not giving any advice or any recommendation. Before we have a deeper dive, just a quick introduction for those of you who don't know me. My name is Numan Ashad. I am a trader at Blackline and TradeZella. I've been trading for 7 to 8 years now, mostly trade futures and equities, and basically I trade the US markets. So the topic, why today's topic is very, very interesting, because it gives you an edge. It gives you an edge. I know everyone loves to trade, and what most people focus on is, you know, catching green candles or catching red candles and catching the momentum trade. And a lot of people always say, okay, on your momentum trades and whenever there are trend days, you basically make a lot of money because there's a lot of opportunity and so on and so forth. Beautiful. But the important part is to recognize when we do get those trend days, and also become involved in those trend days at a good price, right? Because at the end of the day, your entry is the most important thing that matters. Now, spotting those trend days, and also the most important is to know if there's a momentum behind that trend, and that's where market breadth basically comes in. Market breadth tells you if the momentum that you are seeing in price action, if the trend that you are seeing in price action, if there's force behind it, if there's a volume behind it, if big participants are actually involved in that price action and are driving the price higher, or if that move is a shallow move, right? That is the most important message, the most important thing that the market breadth tells you. If you look at the official definition, yeah, it's techniques used to identify the overall strength of the market. But from a day trading point of view, this is super, super important, because at the end of the day, you do not want to get involved in a move, right? Let's say that the price is moving higher, higher and higher, and suddenly you get a strong reversal, and that's where a lot of folks get caught. They get caught in a big fake out. And why most of the times, why those fake outs happen, those fake outs happen because while the markets are moving higher, they go to grab liquidity, right? And in that big move higher, you do not have a lot of participation from different market participants. And when we say a lot of participation, what I refer to participation here is that these sectors, big sectors in the market, let's say be it the semi sector, be it the industrials, be it the financials, whatever it may be, they are not participating in the move higher. And when a lot of when those big sectors, they do not participate in a move higher, you usually get a lot of fake outs, right? So in order to understand if there is a momentum, if actually behind the momentum, if there's a real participation going on, this is something that the market breadth basically helps us to understand. So the question becomes, how do we measure it, right? Now, this topic can be as complex as you want to make it, or it could be very, very simplified. It very much depends on your take on it. Now, there could be multiple ways to measure a strength, measure the strength of the market. There could be multiple ways to look at different tickers, different matrices to understand, okay, what is this telling me, or what is this telling me? But the most important ones, the most basic ones that we are going to focus on today are these 3 to 4 ones, right? And we are going to focus on S&P 500, right? Now, again, if you, for example, look at, let's say if you just trade NASDAQ, this could differ as well. If you just want to trade the semi sector, right? Then for the semi sector, you will have your own data sort of looking deeper into those areas. So it very much depends on how deeper you want to go and what sort of segments that you are trading, or what sort of the markets you are trading. I usually trade S&P 500. A lot of folks out there, they usually trade S&P 500. So these are the most basic tools, basic indicators that measure the strength of S&P 500. And they basically showcase you that if S&P is moving higher, or let's say if we are having a downtrend day, what is the participation behind behind the price action, right? So with that being said, we are going to have a deeper dive on each of those tools. And at the end of the webinar, at the end of this session, we will try to make sense of, okay, how to interpret each of those indicators and how to make a picture out of it. And the reason and why this is important to focus on the last sentence, that is to make a picture of it, is each of these indicators, or even whatever, for example, indicator that you're using to understand the momentum, if you do not understand what information that is providing you, it's not going to help you at all, right? The idea is to use different pieces, right? Different indicators or whatever the case may be, and try to get a picture out of it and then see, okay, what is the message, what is the information that I am getting out of that, those indicators, right? So in this case, the idea is to align those indicators, right? Look at each of that, understand how they help us, and get an information, let's say make a picture out of that to see if the price action, let's say in S&P 500, let's say if the market is moving higher, if there's strength behind it, or if that is not the case. So with that being said, let's have a deeper dive. Just a quick note before we actually move forward. We will do a Q&A session at the end of this webinar, at the end of this presentation. So whatever questions you guys might have, feel free to comment in the chat, and we will go through all of those questions, right? The idea at the end of the day, guys, is that this session, this webinar, you guys take some value out of it, and you can apply these tools into your day trading on every single session and can get some information out of it. That's the entire objective of running this webinar today. So with that being said, let's focus on the first one, which is ad. 3 questions we're going to cover. What is ad? How to use ad to identify strength or weakness, and some sample case studies, some sample scenarios, what you might encounter in real live markets, right? Ad, ADD. For those of you who day trade, you might have heard this indicator, this abbreviation multiple times. Question is what exactly it is. So advance and decline line is basically tells you how many stocks that are advancing and how many stocks that are declining, right? So the number of stocks that are advancing and the number of stocks that are declining. So NYSE, you have around, if I'm not mistaken, around 3K stocks, 3,000, right? So let's say if out of those 3,000, half are declining and half are rising, this line is going to tell you the difference between those two numbers, right? Now, why that is important, again, the question, we come back to the original question, is that if there is a participation, and the most important, what is the degree of participation in the market, right? In a strong trend day, you want to have higher participation. So you want your ad line to be very, very strong. So for example, let's say if the market is gapping up, right, and your ad line is opening with, let's say, 2K or 2.5K or whatever the number is, what is it showcasing you? It's showcasing you that each and every sector is opening up very, very strong. Let me translate it another way, that there's a lot of participation in this move, right? All of the stocks are ticking higher and they're gapping up, and the move is looking strong, right? Now in an ideal trending market, in a momentum move, what do you want to see? That's the question, right? In an ideal market, in a trending market, in a momentum move, you want the strength to remain there, right? So if there's a gap up, I'm just giving a hypothetical scenario, right? Let's say if there's a gap up and the ad line is opening up with plus 2K, you want this number to remain strong and go higher from there, right? If the number keeps on going higher from that from this number, or whatever the case may be, again, the slope is important. What is it showcasing you? It's showcasing you that, okay, first of all, we have a very, very strong participation. And number two is that all those participants, they are holding the ground and the market is continuing moving higher. So in other words, there's momentum in the move. There's a higher degree of participation. So the trend is strong. And what happens when a trend is strong? Again, be it on the upside or be it on the downside. When the trend is strong, you have less probability of a fake out. When the trend is strong, you have less probability of a fake out. In other words, when the market is strong, the buying the dip works, right? When the market is strong, buying the dip works. Why? Because there's a higher degree of participation. A lot of folks are participating. All the sectors are participating, right? That's what you want to focus on. When the trend is not strong, but let's say you are seeing green candles and price just keeps on moving higher and higher, but the indicators, let's say right now we are just to understand the concept right now, let's give this example. Let's say it is declining. It just keeps on going down and keeps on going down and keeps on going down. What does it showcase you? Again, coming back to the point of participation, it is showcasing you that even as the price is moving higher, let's say that you are seeing those green beautiful candles or whatever the case may be, but the degree of participation in that move is coming down. So when the degree of participation in the move comes down, there are two possible scenarios at that point. Possible scenario one, that is a liquidity move, and there's a good chance of a reversal, right? Scenario number two, that again, more or less the same thing, that there's a higher degree of a fake out happening. So the buying the dip thing might not work out as well, right? So that's what ad is telling you. That's what advance and decline line is telling us. It is giving us one piece of information. Again, this is not the whole picture. This is just a part of the whole picture, part of the whole puzzle. And at the end of the session, I hope that we would be able to understand how to combine those little different parts to get a complete picture, right? Now, question, how to use ads to identify strength or weakness. This is something I actually already more or less covered, but to understand it at a much deeper level, let me actually open my charts and give you guys an example of what you will see. So if you guys are using Thinkorswim, that's what I use, one of the best platforms to chart. On your Thinkorswim, you will type $ADD, and this is what you will have, right? This is live information from the market. On a downtrend days, or whenever there's a gap, or whenever we have a little bit of problem in the market, let's say the market is ticking lower, whatever the case may be, you will see down days like this, right? Let's say the ad is opening here at minus 966. Try to reverse, did not happen. Gap up, opened higher, kept on moving lower, not very, very strong on the day. The most important values that I focus on, or you should focus on, is the following ones, right? First of all, you have this 0 as a baseline, right? Here you have a neutral zone, right? On a good trend days, plus 1K, that's where things start becoming interesting. If the market opens and ad starts trending above 1,000, that's when, let's say, you start looking at, okay, the breadth is improving. The most interesting and the most strong days happen when you have the figures around 1.8 to 2K, and it remains a very, very strong, right? That's where it showcases that, okay, the participation is very, very strong, number one, and the market, there is momentum behind the move. There's a participation in the move, right? So that's where things become very, very interesting. Anything that's in between, let's say 0 to 1,000, not, the conviction is there, but the conviction is not that strong, right? Okay, those are values. We have something going on there, but the conviction is not that strong that merits attention. Same applies on the downside, right? Anything that's between 0 to minus 1K, the conviction is not that strong in the trend. It might be a choppy day. It might be a day when not a lot of things are happening. If you start going below minus 1K, and let's say in the figure in the zone of minus 1.5, 2K, and so on and so forth, that's when things become that's when things start becoming interesting, right? So again, the idea is to focus on, now this is again the live market information, right? The idea is to focus on, and I think that will be a very, very good exercise for those of you who day trade, is actually whatever days that you're trading or whatnot, and you actually go back, look at your data, look at your trades, and align this information with your trades and with the market. Okay, what days was, for example, ad trading higher or lower or in the range, or whatever the case may be, and how did the market behave, right? So for example, let's say on this particular day, what happens on 21st, ad opens up on a strong note, 1.3K, very, very strong move down, a little bit of consolidation, and then we dump like no tomorrow, right? Now, if you're seeing a move like this, what does it showcase you? Again, all this information is telling you is giving you some sort of a message, right? What's showcasing you? Showcasing you that, okay, we had a strong opening, we have a strong opening, but the participation is weakening. So when the participation is weakening, question becomes, does it make sense to buy the dip, right? No. Here we try to reverse, and we got rejected very, very, very strong, and we started moving lower. So a very, very strong down this. That is a very typical behavior of a day which opens very strong or which opens with a gap higher, but the strength is not maintained, and we trend down on the downside, right? So this is just to give you guys example. Whatever I'm telling you, this is very, very basic, guys. And again, the idea of this webinar is to introduce you to this topic of market breadth, make a let's say base case, a base foundation, and basically take it from there. These are just very, very some basic examples for you guys to sort of understand the concept, right? So this is how it will look on your charts. Now, coming back to how do you use this information once again to identify strength or weakness, right? There are three scenarios as we have sort of discussed here. One is the bullish scenario, second is the bearish scenario, and the third, let's say, a divergence scenario, right? In a bullish scenario, as I stated, let's sum up this factor, is in a bullish scenario, you want the number to either open up strong, or if it doesn't open up strong, it starts trending higher, right? And the strength or participation is maintained. That's what you want to see, right? Again, the underlying message in here is that there's a lot of participation, there's a lot of activity, and the bulls are holding the ground. That's what you want to see. A bearish scenario is the completely opposite, right? Either the market opens with a massive gap down, or it opens higher, as we just seen in an example on TOS that I showcased you guys earlier, and we go for a big dump. We do not hold the ground, and we start going down, right? That is a very, very typical case scenario of a downtrend day, right? Now, that is also showcasing you that as the price is moving lower, you are seeing the participation in the market. There's a lot of participation, there's a lot of activity, and the trend on the downside is strong, right? That is what is showcasing you. Now, the third scenario, which we call a divergence scenario, is where things don't align together, right? Things don't align together. That is, for example, you see big, beautiful green candles, but the participation is lower. So one line is going higher, the second line is going lower. That is not the ideal scenario that you want to see. What is it showcasing you? Again, all this is a bit pieces of information that's giving you a lot of edge, showcasing you that the participation is not strong. So once again, when the participation is not strong, there's a higher probability of a fake out. There's a higher probability of a reversal, right? So those are the divergent scenarios. Again, beat on the upside, beat on the downside. Those are the scenarios that you want to avoid, and ideally not to take a trade in those scenarios, because again, those increase the likelihood of a reversal happening. So those are the three scenarios, and this is how basically you sort of interpret the ad, which is advance and decline line in S&P 500. Once again, guys, I hope you guys are able to take some value out of it. Also, if you guys have any questions, feel free to just write in the chat. I am seeing the chat so far. I appreciate it a lot. I hope this is helpful. And at the end of the session, we will have a very quick Q&A as well, to make sure that if there are any questions or whatnot, they are, we answer them. Second point that we are focusing on, the second metric, second indicator is VIX. What is VIX, how to read VIX, and the price movement. Now, VIX is also known as the fear indicator in the market. Very often, whenever there's a volatility, whenever things are going wrong, whenever there's a headline running, you see some massive dumps happening in S&P 500, and you see VIX gapping up like no tomorrow. And you will see headlines running on CNBC. The market is in panic that the VIX is trading at the highs or whatever the case may be. Question is, what is VIX? Like, how the market actually measures the fear, so to say, if you want to call it, right? How does the market measures the fear indicator? Now, markets are forward looking, right? You all know that. Everyone knows that. What does it mean? It means that and S&P 500 is actually one of the most efficient markets out there in the world to trade. What market makers do, or basically what the market participants do, is that they try to forecast the expected volatility in the market. What does it mean? It means that they try to forecast what is the probability in the future, let's say for the next 30 days, that's where it heavily places its focus on, that what is the expected volatility in S&P 500 during, let's say, the next 30 days, the next 60 days, next 90 days, whatever the case is. Or in other words, how much they expect the price to move within the next 30, 60, or 90 days in S&P 500. And based on those calculations, now there are a lot of calculations running behind different type of models, whatever, XYZ, they try to forecast that price movement, right? And that's where the VIX is coming from, right? The base case scenario is that there's not a lot of volatility at S&P 500 and the things will remain stable. That also translates into the average true range, right? ATR. What does that mean? That means that on average, the market participants, let's say, believe that S&P 500 will move, let's say, on average 20 to 30 points in a session. So based on that, you have a very good, interesting forecast how they behave, how the markets are supposed to behave, and how the options are priced, or whatever the case may be. Right, so now the options pricing, VIX, that's a huge, another topic which we will probably discuss in some other webinar. But that's basically the entire idea of VIX or fear indicator or whatever it is, right? Now, when the VIX goes higher, that means the expected volatility, there's an expansion in expected volatility. So the market participants, things become very, very volatile. So the forecast or whatever the stable forecast goes out of the window. That is all where that so-called the fear indicator coming from, right? Now, you don't need to, let's say, go through all those models and go through all those terminologies and so on and so forth. The idea is just to, sort of introduce you to the concept of, okay, where those numbers are coming from, right? So if you're seeing there's a fear indicator is running high, or there's a lot of fear in the market, where that entire data is coming from. So that's where more or less it's coming from. The most important thing for you guys to take away from this slide is how to read VIX, right? Now, there are three layers, sort of three buckets, if you want to call them, in which basically you should interpret VIX. This graph showcases you a very, very nice picture. It's basically a bell curve behavior, bell curve, which is a very standard statistical concept. I'm pretty sure most of you are aware of it. You can apply that concept everywhere. Basically, it's like what it says is that most of the data is concentrated around the middle. You have very exceptional data on that side. We have very exceptional data on that side. That basically showcases you. Another very interesting topic. But anyways, VIX. There are three buckets that you should focus on. Number one is anything that is in between 12 to 20 is considered a normal VIX, right? So if you have a reading between less than 20, let's say a reading less than 20 is usually considered all right. A VIX below 12 is typically considered low. A VIX above 20 is typically considered high. So these are the three major buckets regarding VIX. These are the three, let's say, categories, price levels, whatever you want to call it, you should focus on. Now, what happens? Let's quickly go to the chart and let's see what we can take away from VIX, right? If you go to your Thinkorswim chart, you will type VIX, and this will showcase you the Wall Street famous fear gauge, that is VIX. This is what you will see. This is very interesting daily candle, a lot of messy candles, and this is basically 5-minute chart. What are we seeing? We are seeing VIX in the range of 15s, right? That's what ideally you want to see in a bullish market. That's what we established in the previous slide. VIX in ideal market, let's say below 15, 12, 20 range. In a bullish market, that's what you want to see, right? Here things are, I think, way more interesting. Look at that. For example, here we got a very, very strong spike all the way to 19. Now, if you line this information with S&P 500, you will see a massive dump on S&P 500. On that particular day, we have a very, very strong spike. We did get a spike, but it was not dangerous enough. And what do I mean by dangerous enough is that around 20 mark is where things, like, in fact, actually I have marked it, is where things become volatile. That's where when we see the markets start dumping, that's where things become very, very interesting. So anything below that, ideally you want to see a downtrend, beautiful, but anything below that, and specifically if you see, things trending like that, and ideally, let's say below 18s or whatnot, this is what you want to see in a bullish market. In a bearish market, what happens? You see very, very strong move, and especially VIX does not bid below 19 to 20 zone. Whenever I'm saying a mark, let's say if I'm saying 20 or 22, it does not mean always one specific level. We always refer to as a zone. So 20 zone on VIX is extremely important. So in a bearish market, let's say if you see strong bid above 20, you see that, okay, things are becoming very, very volatile. So let's look at a very, very interesting example here. Okay, that was way before when the Trump thing happened, right? We got a very, very the President Trump got inaugurated. He came up with this entire tariff thing, whatever, that we are going to die and we are going to impose tariffs and all that. look at the price behavior. We got very strong price behavior on VIX. Again, what it showcases you, it showcases the things become very nervous. And when you see a VIX trading or trending above 20, like look at that, for example, 20, that's where things become extremely volatile in markets, right? So going back to our charts, ideally in a let's say markets that are trending higher, you want to see VIX trading/trending lower, right? Ideally trending below 18s into 12 to 20 range. So the most important that it should not get above 18 or 20, right? Again, we are focusing on the trend, guys, right? That's the most important thing. Below 12, beautiful. In a downtrending market, you want VIX to hold the ground in 20s and basically go take it from there, right? Here is a very interesting example on VIX. This is actually a very old example when S&P 500 dumped back in COVID times. This is still an old picture, and we had a massive spike on the VIX side. So that is basically VIX, right? Again, later on, guys, we're going to combine all this information and try to make a picture of it. But again, here the idea is to introduce you guys to this concept and basically take it from there, right? So to sum this up, what VIX tells you is that it's a fear gauge in the market. It showcases you the possible, the implied volatility in options, and the forecast move on S&P 500. And the most important thing for you guys to know is these buckets, like what are the important levels for you guys to sort of focus on in terms of day trading, and in general, even if you're swing trading, what levels the VIX is trading at, if there's a volatility, if there's no volatility, and so on and so forth. So that is VIX, guys. Let's focus on the next one, which is tick, and this is the most important one. We will try to understand why it's important and how to understand its reading. So this is sort of official definition of tick. It summarizes the number of stocks on NYSE that are increasing in price versus the number of stocks that are decreasing in price from the previous quote. This is how you will see the chart. Tick is the most important, specifically in a day trading concept. So if you're day trading, this is the most important thing to focus on. Number one. Why? Because it captures the pulse of the market. It captures the pulse of the market. Why? Because it gives you the live quote, live as things are happening. That's why it's called the pulse of the market. Now, if you look at a tick chart, actually, let me showcase it to you guys right now. You won't really understand a lot of it. For those of you who are trading on Thinkorswim, you will put the $ TICK. It's a very messy chart. You go on the 5 minute, you see there's just a lot going on. You won't really see how to read this, but there's a way to read it, and we're gonna go through it. The most important thing is to sort of see, okay, what do you expect when you actually look at a tick chart. This is what will pop up when you write TICK in your charts. There are 3 zones which are important when we speak about tick. Number 1 is the baseline. Now, for the baseline, 0 is your baseline, right? You have a 0 mark, as we just showcased. I just showcased you before. That is your baseline. For a bullish momentum, you want a reading above 600, and more specifically, that reading to be maintained. For a bearish momentum, you want tick to continuously give a reading below 600, and you don't get a lot of readings above the neutral line, which is a 0 base, right? So you don't get much going on here, but you get a lot going on over here. For example, chop like this, chop like this, chop like this. That's what you want to see. For noise and chop, you have a reading between plus 400 and minus 400, right? So let's go back. This is basically how you understand tick. Let's go back once again on back to our charts and see how to interpret that. So this is your baseline as 0, right? Anything in a bullish momentum, even though let's say you see that the price is moving higher, let's say this is approximate, you have minus 400 something around here, right? You have 400 around here. So if you see a lot of movement in that area, that usually means that the market is chopping around. For a strong momentum bullish days, you want continuous reading above 600. For strong momentum down days, you want a continuous reading below 600, right? Now with tick, there's a very, very important thing is that is a reading of 1000. And those readings on tick, 1000, those are extreme readings. So what most of the professional traders do is that whenever you get a reading of plus 1000 and minus 1000, you reverse it. You go to the opposite, you take the opposite direction of the trade. And why that is the case? That is the case because a reading plus 1K or a reading below minus K, that is not sustained. That means exhaustion happening, right? That means exhaustion happening. So what a lot of what folks do is that whenever, let's say, market hits with a strong, opens up with a big gap higher, and right at the open you see a reading of plus 1K or plus 1.2K, whatever the case may be, they instantly take a short trade, literally within a milliseconds. And the assumption behind that is that we are going to get a very strong move on the downside very quickly. Why? Because those readings in the 1K or minus 1K zone, those are exhaustion readings, and those will not be sustained moving forward in the session, right? So you usually get a very, very quick plus 10, plus 20 points or whatever the case may be, a very, very strong move. So those are, let's call them exceptional readings, which are also very, very important to know. Now, literally there are folks who just take those trades. Literally, they go heavy in size, and take trade of the extremes, right? Again, those extreme readings, those are the exhaustion buckets, exhaustion marks, and that's where things start reversing very, very quickly. So to sum it up, to understand tick at the most basic and most comprehensive way, those are the 4 things that you need to focus on. For a bullish momentum, you want a reading plus 600 and continuation move higher or being sustained. For a bearish momentum, you want a reading below 600 and a sustained below that. For a noise on chop, usually this gives you a very, very good understanding if the tick reading is just going up and down between 400 and minus 400 range. That usually indicates like there's a lot of choppiness, or there's a probability that the market will just range during during those certain levels, and that's basically it. And the 4th scenario, that is the exception scenario, that's an exhaustion ratings where you have plus 1K and minus 1K and basically so on and so forth, right? So that's another important indicator. That is the tick part. Now the last one, and again these are the very, very basic scenarios that we are going to cover today, is the TRIN part. Now what is TRIN and how it integrates into our thing? Let's sort of focus on that. Now TRIN focuses on the volume part, and most importantly the relative rate at which the volume is flowing into advancing stocks or declining stocks. When you are putting TRIN, you usually get a reading which is above 1 or below 1, and this is how basically you interpret it, right? It showcases you the reading in a single digit format. If more volume goes into advancing stocks than into declining stocks, you usually trend falls and you get a value below 1. If it's the opposite, yes, you get a volume, you get a reading above 1, right? Now, there's one thing that you should keep an eye on, is that just that, let's say if you get a value above 1 or if you get a value below 1, this does not mean that you should just blindly go ahead and try to short the market or just try to long the market. No, this is not the idea. The idea is basically when you start getting those readings and things become very, very interesting, those are the zones. That's when you should focus on the market and see, if there's a probability of taking a trade, right? If there's a momentum behind those trades. So in order to look at TRIN, you type $TRIN, and this is how the chart will look like. And this is basically what you will see, right? Now, again, there are two things that we want to focus on whenever interpreting these sort of values or these sort of indicators. That is, and that is valid for any indicator that you are using, right? Be it this one or be it whatever other one or whatever the case may be. And that is the number or the value at its face value. That is what you are getting. But the most important is its slope, right? And how it's progressing. So the progression is the most important part that you want to focus on, be it on the upside or be it on the downside. What do we mean by that? What I mean is, let's say if TRIN falls below 1, you don't want to just go ahead and take a bullish bet, right? No. The idea is that if you get the reading that you are interested in or that you are watching, then you start looking at, okay, how the market is behaving, and most important, how that particular indicator that you're focusing on, what is its progression from that moment, from that value. Is it sustained or is it reversed, be it again on the upside or be it on the downside? So those are the most important things that you should focus on, guys. Now, of course, there are advantages, disadvantages with any sort of indicator. As I have already mentioned, be careful interpreting the positive or negatives, because they could give you, sort of misaligned picture. Now, let's go to the playground and let's try to sum it all up, and let's focus on how to interpret all what we have discussed so far. And let's try to build a picture together, because that's the most important thing, right? We want to use this information to make a picture and try to see how we can use this information in our day trading, right? So let's sum it up. The first thing is what we discussed is the ad, right? So in a bullish momentum, we discussed that we want a very, very strong volume, very, very strong value on the ad. And the most important thing, again, is the progression, how that is progressing from that moment onwards during the session. For a bullish momentum on the tick, we said that we want strong value, let's say plus 600, and most important, how is the progression from that particular moment. VIX, we said that we ideally want a value that is trading 15, let's say, and below, and we want to see the progression. And the same with TRIN, right? You want a negative value and you want to see the progression. What is the most common thing that is there in all of those 4 indicators? That is the progression from the start, right? Because that progression, again, we're coming back to the first slide that we discussed earlier, and that was the measure or the degree of participation in the market by big folks, the momentum behind the stock or an indices, and basically lowering the probability of a fake out. And how do you lower the probability or a chance of a fake out? You focus on the progression of these values. That is, okay, on a S&P 500 chart, you are seeing green candles, beautiful. Looks like the market is just going to rip higher, and today we are going to all-time highs. But what is going on under the hood? How is the participation in that move? That is what all these things are telling you. Are there actually folks who are participating and actually buying the market, or this entire thing is just a fake out? That's just a liquidity run. This is what it is telling you here, right? So if you see weak market participation, but price just keeps on going higher, what does it showcase you? Higher chances of a reversal versus the other way around. If you see a price going lower, but internals, these are also called, by the way, market internals, market breadth. There are different names for it. Similarly, if the breadth is very, very strong, let's actually open the chart and let's, try to sort of simulate a case study, let's call it, right? So again, this for those of you who don't know this platform, this is Think or Swim, guys. Very, very popular platform. Here we are going to put ADD add, and here we are going to put what is left, TICK. Now this is your market breadth. Right here, same we are going to apply for TRIN, same we are going to apply for WIX, and same we are going to apply for TICK. Right now, this is your market breadth, this is your market internal at the most basic level, right? This is not advanced stuff, guys. This is the most basic level, and the idea is, to at this level, you start with the basic and then start building from there. Right now, you can do a lot of stuff with this sort of information, right? You can try to build a study, you can try to build a metric, combining all these things, right? So let's say if the value of a metric is above this, that showcases mean the market is progressing, the market momentum is strong. If you combine all this information and let's say make a little value, whatever, if it is below that, that's showcasing me the progression. So there are a lot of things that you can do with this sort of information, but the idea is to understand at the most basic level, how does this look like and what these things mean, right? So for example, this is the price action. Sorry, this is the market internal for the last session, right? What we are seeing a very interesting progression. Again, the word is progression on TRIN, right? Very, very interesting progression on the downside. Very interesting progression on add. We bottom at the neutral zone and we start trending higher. Now, of course, this is not the best case scenario because we're still trending in a 1K range, but what's important is look at how the progression is, right? Here, tick, what you want to focus on again is when the live information is happening, what is happening at the neutral zone slash the chop out zone, right? So if we are getting more bid maintained above the neutral zone, or if we are getting more bid maintained below that. And the same applies for the weeks, right? And now let's look at the SPY chart, S&P 500. Look at that. Beautiful, beautiful uptrend day on S&P 500, right? So what is this information giving? What is this showcasing me? It's showcasing me that in this trend, there's a lot of participation going on. There's a lot of momentum behind it. There's a lot of activity happening, and folks are buying the dips, right? So it's a very, very healthy uptrend, very, very bullish momentum. So in this sort of market, you want to buy the dips, right? Now, if it was a reverse case, such as, let's say, the values were reversed, the same on add, the same on tick, the same on VIX, the same on TRIN, that will give you an indication, sort of a warning sign that things are not looking the best, and this could be a sort of fake out move, right? So that is the market breadth, guys. This is the market internals at the most basic level. We have not discussed the most advanced stuff, right? That's something we will likely do in some other webinar. This was a very introduction webinar, sort of getting your hands dirty at the very start, but the very basic level, introduction to market breadth, market internals, and how you can use this sort of information to actually gain an edge in the market. Now again, this is the sort of information that hedge funds, day traders, trading at the floor, they use this information on every single day and try to build a picture together, right? For a bullish case, for a bearish case, for a divergence case, right? For example, if everything is diverging but the price is going for a liquidity swaps, right? Does it make sense to buy into it, or does it actually make sense to reverse it, right? So this is the sort of information that gives you an edge, that tells you what's going on under the hood of the price, right? So this is a price right here. It's not giving me any information in terms of what is going on under the hood, right? If this momentum has some legs in it, but if you're seeing all those related things that are giving you extra confirmation, extra information from a volume point of view, from a tick point of view, from the volatility point of view, from advanced decline point of view, that is giving you a lot of edge, right? Then you have more confidence in placing your trades, then you have more confidence and conviction in your setups. And that's what that's the entire objective and the idea of market internals, market breadth. Again, today's session, we have not discussed the things at the most detailed levels. This is the most basic levels that we have explored today. And the following webinars and follow-ups moving forward, we will likely run some more advanced stuff as well, build some case studies, build some simulation cases, and take it from there. So I hope this guys, this was a helpful session. And now we come to Q&A session. I can see in the chat there's a lot of activity going on. If you guys have any question, feel free to ask me right now. If everything is clear, I don't think there are a lot of questions going on. Okay, would love to see the advanced stuff. Yeah, 100%. In the sessions moving forward, we will definitely look at some advanced stuff as well. Maybe try to, as said, try to build some case studies. What you should, for example, focus on in case of divergence, what you should focus on in terms of, let's say, combining, for example, all these values and maybe, let's say, making an indicator or making a breadth, breadth reading or whatever you want to call it. What is the probability, let's say, when the market opens and we right at the open, let's say right within the first 30 minutes of the open, we get an idea that market might chop. What are those readings that we should focus on? That's something maybe we in the next advanced stuff at an advanced level. That's something likely we will discuss. Okay, any more comments? Nice explanation. Thank you, Luis. Yes, it was Think or Swim. Robert, what is the name of the charting tool? Yes, Think or Swim. That's by Charles Schwab. Working fine now. Okay. Yeah, that is pretty much all, guys. That's market breadth at the most basic level, and I hope it was helpful. If you guys have any questions, feel free to shoot us a text at TradeZella. I look very forward to seeing you guys in the community. If not, thanks very much for attending this quick webinar, Market Internals. And moving forward, I will see you guys in other webinars. Have a great rest of the day, rest of the weekend, and goodbye.